I want to introduce our incredible panel. Okay, so AJ Bruno, founder and CEO of QuotaPath, Graham Collins, Chief of Staff at QuotaPath, and then Mary Grothe, CEO at House of Revenue. Thank you three so much for being here, and welcome to another Sales Hacker webinar.
Thank you. We're all excited to be here.
Great. Okay, cool. Well, before we dive right into the conversation, I do like to kind of set stage a bit and get a bit more information on each one of you, so everybody that is here can get a bit more acquainted with you guys. So please, I'm going to start with Mary. Mary, do you mind just giving a bit of background on yourself so we can get to know you a bit better?
I'd love to. I'm Mary Grothe. I'm the founder and CEO at House of Revenue. Short story about me. I had 2 stints with Fortune 1000 payroll and HR company Paychex. I'm a former top producer for them. During that time is when I learned how to break comp plans and be a troublemaker when it came to all things compensation. I feel very qualified today to speak on the topic, mainly for that reason. But I've been blessed beyond measure in the last 4.5 years to lead a team of branding, marketing, sales, CS, and RevOps experts, and we scale companies for a living. So through the last 4.5 years, I've built, 100 different comp plans, comp models, and for revenue teams, not just salespeople. I'm excited to drop some of that knowledge today and also learn from AJ and Graham.
Amazing. Well, thank you, Mary, so much for blessing us with your time and knowledge. I'm excited to hear what you have to say. I know we're all very passionate about this, but I'll throw it over to AJ. AJ, do you mind just giving us a bit of background on yourself and what you're all about?
Yeah, sure. Thanks, Mike. I am founder CEO of QuotaPath. We'll talk a little bit about QuotaPath, but this is my second company. My first company was based here in Austin, Texas, where Graham and I are. We are a phone booth away right now. That company was in the PR attribution space. I was founder and president, ran the sales team. We grew to 0 to 30 million in about 2.5 years, 3 years, 4 years. Graham was sales hire number 2 at the organization. And he'll give his introduction, but had a quarter where I had a sales rep come up to me and say, "Hey, AJ, I think you paid me incorrectly. Here's my spreadsheet." And you all are out there and you've all been in a situation where you probably it just hits you. You look at your paycheck, it doesn't match what you thought it was going to be. And it's super, super frustrating experience. We've all been there. Mary talked about paychecks. She's probably been on the other side of it and hearing it as well. So it's something that we just dealt with. We looked at solutions in 2016, couldn't find something. Trendkite sold in 2018, started QuotaPath around that time. Graham joined me shortly thereafter. We're dual headquartered Austin and Philadelphia and Maine, not Maine. Graham's in Maine, not Maine. And we're about 70 folks. We raised our Series A from Insight Partners and a few other folks, including HubSpot Ventures, and growing super fast. We have about 400 customers today, and just continuing to grow and help people with the real pain point. What's the right type of compensation plan, and how is that changing? How should I adjust it? All of that good stuff that we'll get into today. I guess I'm kicking it over to Graham to wrap us up here.
Yeah, for sure. So AJ gave a little bit of my background, but my title is Chief of Staff at QuotaPath. So I was the 4th employee here. Really, I tell people that I do a job until we hire someone who's better at it than I am. And so that historically has been sales, marketing, customer success, some RevOps, finance, partnerships, just dipping my toes in a whole bunch of different areas. But over the past almost 3 years now, I've been doing a lot of comp plan consults and comp plan counseling, I suppose, for folks, helping them build their comp plans. And that's everything from I need help building my very first comp plan, all the way to, I have a scaled team, I need just a few pointers, or, hey, can you just give me the seal of approval? So I've done over 300 of those comp plan consults with sales leaders. Obviously, anybody on the call here who's interested, I'm happy to sit down with you. It's under the resources tab on our website, quotapath.com. But happy to sit down with anybody and chat through that. But I see a lot of comp plans and a lot of issues and a lot of ways that comp plans can be improved. So I'm happy to be here and chatting through that with folks. And yes, I'm the sole member of the Maine office of QuotaPath. Maine with an E at the end there.
Amazing. Well, clearly we got the experts here, and I'm excited. Guys, so this is your chance. get your questions in, throw them in the Q&A. These are the right people that are going to be able to answer those thoroughly and give you some great takeaways and insights. Okay, so any questions, throw them in the Q&A. I'll loop them in, and we'll get those to you. But with that being said, let's start off the conversation here. Okay, so I want to start off with a couple, just to set the stage here for what we're going to be going through, and just throw out a couple stats that are pretty crazy. So McKinsey did research from 2021 that revealed 40% of employees are at least somewhat likely to leave within 3 to 6 months of joining a company, and 36% of those will leave without having another job lined up. Right? It's crazy. And to add to that, in the world of sales, it's even more prominent, right? The rate of turnover on sales teams is 27% higher than the overall labor force, and sales compensation plays a major part in that, which is exactly what we're going to be tackling today. Okay, so hopefully we can give you some great insights on how to avoid being a part of those astonishing stats, and make sure you are keeping and retaining top talent at your organization. But moving on, I do want to start off, and I'll throw it over to you, AJ, to kind of kick it all off here. But there are a lot of trends moving into 2022 around on-target earnings, quota attainments, retention of your reps. What kind of trends have you started to see moving from 2021 into 2022 that you think a lot of other revenue leaders and sales leaders and finance leaders should start to really address in more kind of more
Yeah.
detail?
I mean, I think that the 2020, 2021, and 2022 have all had their own trends and flavor of trends. The thing that I'm seeing that's actually pretty interesting is stability and consistency. I think that's actually started to. There's a lot of shuffling. We all know this, but using stability in your comp plan as a differentiator is actually fairly fascinating. What I mean by that is, in the last 2 years, we've seen a lot of changes quarter to quarter, even inter-quarter changes to variable compensation plans. It's changes to quotas. Quotas raising, of course, OTEs raising at that same rate. So that's a 20% jump across the board. You'll see those go linked hand in hand. The OTE to quota ratio is still stayed in that 3, and Graham can talk a little bit about this as well, 3x to 6x, meaning if you have a sales rep of an on-target earnings of 150K, you would typically expect to see 3 to 5.5x of that in their total quota. And that's pretty common. But the challenge is, if I'm in a sales team, I'm a fast growing sales team, and so many things are changing. You deal with agility and flexibility. The thing that you just don't want to screw up is compensation. And so making those changes, or even retro changes, which we've seen, can be tough. We have a customer that has 250 sales reps, and all of their quotas were retro changed for Q1. And we're dealing with this right now. And some went up and some went down. And I'm not 100% sure why. We saw that a lot in the previous 2 years, but I haven't seen that as much. And I think that's a good thing. That's a retaining, and an opportunity to make sure you're recruiting people. When you ask a recruiter, well, how's the team performing? How are they attaining? Right there, you want to see consistency and predictability, and not just the attainment, but also in the plan itself. A very important trend that we're seeing, and hopefully Graham can back up all of the things I just said in data, because I tend to make things up. And so, Graham, is any of that true?
Don't worry, I would have chimed in. If anything was egregiously wrong. I think that one thing that you called out there, AJ and Mary, I saw you unmuted as well. I'll let you talk here in a second. But one thing that you commented on there is the that quota to OTE ratio multiplier that we see, and that's a pretty common way that organizations set their annualized quotas. We have seen a little bit of a lowering of that over the past couple of years. So on-target earnings are increasing. Quotas are increasing as well. On-target earnings are increasing a little bit quicker. So they're increasing about 10% quicker than the quotas. So you are seeing occasionally situations where maybe somebody, their quota, their on-target earnings went up 25%, but their quota only went up 10 or 15%. So, Mary, what were you to add in there?
Yeah, I've been in a CEO or CRO seat for the last 5 years or so. And the biggest gripe, because I'm a former top salesperson, so I'm always an advocate for salespeople, especially talented, high performing salespeople that can just cut through the BS and comp plans, especially when they're interviewing. And it's always the biggest gripe is how attainable is this comp plan? It is tiring to see these employers taking away talent based on lies. And they're showing in their these high OTEs and they're dangling this carrot. And salespeople, like any salespeople on this, please, in the interview, you have to ask how many performers are at plan, how many are over, and how many are under? How long has this plan been in place? What are the KPIs? What was the data behind creating this quota, this comp target? Tell me more about the science behind how this was created. And I think salespeople need to get a lot smarter in the interview conversation and digging into that. Now, from the salesperson side, I'm actually the CEO of House of Revenue, but in case some of you saw my LinkedIn post that went out on Saturday, I'm actually stepping back into the CRO seat as an investor and an entrepreneur and a CRO. So I'm in a unique position now where I'm investing in some young companies and I'm in the CRO seat to drive the growth. One of the first things that I do is just slash through the financial model and the sales pro forma and how they're going to market to attract salespeople, pay salespeople, and what all the targets are based on. It's one of my biggest gripes in the way that people build this side of the house. So AJ, when you brought that up, is this even attainable? Like we have to get smart because employers are stealing talent at crazy rates right now. There's so much uncertainty in the market. Also, because salespeople are in high demand, they don't have fear anymore of leaving a job after 3 months. They used to hold on to craptastic roles because they had a fear of like, I can't show turnover in less than a year because then it's going to be held against me in future hiring conversations. And now people are jumping ship so fast, left and right, the great resignation, reshuffle, whatever you want to call it. It's tough. So salespeople, like the grass is green where you water it. Figure out the conversation around your comp, like be an asset, be part of the solution to your company. If the comp structure, the quota, the KPIs, it's not data driven, it was based on somebody in a board meeting be like, we should grow by 20% this year. Yeah, that sounds really good. Let's increase everything by 20%. And then there's like no data or science. Like salespeople need to step back into a place of authority and start driving better conversations if they're going to be held to these standards. So AJ, you just got me a little fired up with that
Well,
comment
no,
there.
So Mary, but you nailed it in the sense that, oh, first off, congrats. And anyone that steps back into a CRO sales leadership seat, they absolutely love sales. You have to,
Yeah,
you
it's like a sick
have to.
obsession.
Yeah. So the question I have though for you, Mary, and especially since you're working with smaller startups and you're seeing this, is they don't have that data. They don't have the attainment data. They're not going to have that. And they're competing against companies that are super well invested, that are spending a lot of money on higher OTEs. The book of businesses are getting quote unquote bigger, and that their recruiters can spin these large tails. What would you tell like these smaller startups that don't have it, but they need to do exactly what you're saying in recruiting? How should they be thinking about those conversations with a key sales hire that they might need to make?
Yeah, funny. So I'm interviewing for a key sales hire right now for the tech startup that I'm invested in. My interviews go something like this. I have no idea what the numbers are. So I'm going with a flat base salary with an OTE that's based on quarterly bonuses that's not tied to commission or per unit sale because we just don't know what the numbers are. My entire go-to-market strategy is based on a hypothesis. And this is my hypothesis. I benchmarked it against other companies in my own primary market research. And this is what I'm launching to the market with. I'm going to launch this for 90 days, and then we're going to actually accumulate data, evaluate it, and then at that point, we'll work together to figure out what the actual compensation plan or KPI targets are going to be. And by the way, if we don't have consistent data that can be relied upon and we need to accumulate more, then we're going to keep it at this rate. Additionally, like when you're looking at how are you funding the growth of the sales team in an early stage company, part of the argument might be like come up with your ideal candidate matrix. And if you know this type of profile is going to cost us $125 on a base and a 250 OTE, then go raise so you can get that person. Like, who cares if you're profitable out of the gate? If funding is part of your strategy, get the right person. But the founder that says, well, ideally we would have this level of person and comparably they're making this, but let's see if we can get away with, straight out of college, scrappy, willing to. I'm like, oh my gosh, you guys, you're a startup. You don't have time. Like you don't have a 6-month mentorship program to train somebody because you're going to bring in cheaper talent. And then 6 months, you're going to be frustrated because the needle didn't move. And then you're going to re-spend the money you just spent again, probably again the wrong way. So it just comes down to like, who's going to move the needle? What kind of salesperson do you need? And if the answer is you need to go for those higher salaries to attract the right talent, like people need to pony up and pay the good salespeople what they're worth. And you got to have the right interview practices because I'm seeing so much in the market right now. And salespeople are great interviewers, by the way. They tell you everything you want to hear. And it's super weird because like the person who interviewed isn't the person that shows up to the job. They're like, what's a phone? How do I make calls? Anyway, so AJ, like the point here is in my rambling is what does the business need? And I would cut it in a grid into the RPAC hiring methodology. So role match, proven achievement, acumen, and culture fit. And if the earlier stage company, the more entrepreneurial they need to be and be able to think on their feet and almost have that founder sale mentality when the prospect's like, do you do this? Sure do. And then they need to go back to product team or whoever and say, hey, we've got one on the line, but can we do this? Like they have to be more in that mindset. They can't be black and white, need structure.
In that framework, in the culture framework, that you had, or that framework, sorry, that you had 4 quadrants with, I said culture. If you're earlier stage, is there a quadrant that you're leaning towards? There was one that I just preemptively leaned towards.
AJ really showed his hand on how he
culture piece of it, but is there one piece that you're thinking about when you're employing this type of framework with these founders?
Yeah. Here's the deal. Like I need performance when I'm a startup. Like usually the people that get you from 0 to 1 may not be the people that get you from 1 to 5 or from 5 to 10. And in 0 to 1, like what I've learned is, culture is important. Like I need to have somebody that's scrappy and enjoyable to work with, but I can't have somebody who's like really scrappy, down for the cause, enjoyable to work with, and can't perform. I have to have performance out of the gate. And oftentimes, like I'm willing to deal with bigger personalities or some adversity because in that early stage, like I need a hustler. I need somebody that can get the results. And then if they're not the right long-term fit, then we have a different conversation. But my bias is towards like getting the job done. But culture, like you have to enjoy the people that you're working with.
Yeah, no, I think what I really meant by there, so our performance is usually just like that's table setting. And we're fortunate enough, Graham and I are fortunate enough to have worked with like, all of our sales hires here. We've worked with previously. We know they're going to perform. But the first sales hire we had previously at Trendkite is very different than the one we had at QuotaPath. And it's culturally where they're different. And that like the ones at Trendkite, don't get me wrong, out of the first 8, I think all 8 of them became top performers or sales leaders themselves. But they were super strong on performance and sales in the new business front. Here, we're looking more customer journey holistically. And I think that speaks more to culturally, how do they connect to the customer versus just the sales, that urgency and the sales acumen, all really, really important. Sorry, Graham, Mikey, I'm not like, Mary and I are hogging the entire conversation. I really enjoy the thread.
Banter, we love it. This is what we're all here for.
I was hoping we were going to have a big disagreement on that one. That's what I was really looking forward to. Was AJ to say that culture is way more important, and I do. I tend to agree with AJ there that performance is kind of table stakes, and I would rather have not a middle of the road performer, but like an above average performer who can help drive the type of sales culture that I'm trying to build, as opposed to a top of the line sales performer who creates a really, not really toxic culture, but like a less ideal culture. But Mary, I think it's interesting. You clearly care a lot about sales culture. And so I wonder if it may have to do with the fact that your personality is, and the way that you create sales teams already does that driving of the culture. Not to say
I thought I had to just pick one. I thought this was like a game show. You can pick a role match, a proven achievement, culture, acumen. You pick one. Like that's why I just went like, culture fits are great, but like I'm not a nonprofit. If I get brought on by a startup, like they're here because they need performance and movement. So that's why there's 4 quadrants, because you have to have a hire that hits all 4. But I thought this is like Survivor or something. Like pick the one.
No,
I'll put it up with a wonky attitude for.
You can't. There's no negotiation. There's no compromise in here. Well, one thing that's interesting, you had talked about. Obviously, we've spent a lot of time here at the beginning here talking about very early stage sales hires, your first sales hire, your second sales hire, 0 to 1. It's very different than hiring your 91st sales hire or your 101st sales hire. And that's what, I assume several people on the call here are dealing with, are trying to hire those folks, competing against Google, Amazon, and people who are paying $250,000 when their structure is, this is how much you get paid. So, Mary or AJ, I'd love to hear your take on this. Like, how do you compete against those people who are offering outrageous on targets at well-established companies when you don't need to hire the first sales hire? You're hiring your 15th or 20th sales hire.
Can I add something to that as well on top?
Yeah.
Just how would you also alter, say that comp plan for that first sales hire compared to the 91st sales hire? Would it be more customized for that first sales hire, or would it, and would the 91st one be more standard across the larger team? Just to add.
I mean, I'll take that one. Yes, and Mary alluded to it. Like, your first sales hire, trying to say, hey, you're going to get this standardized comp plan is ridiculous. There's no way that you can standardize a comp plan, and you have to hire a person who's willing to accept that. You can't hire somebody who needs a well-established, this is the comp plan, this is how much you're going to earn. You have to have somebody who's willing to be open to that for your first few sales hires. I mean, in our first 6 months hiring a sales team here, we changed the comp plan 2 or 3 times because things change. It's not ideal, but they rolled with the punches, and they're now leading the sales organization. And so, I'm a big proponent of standardized comp plans, which is why this question is sticky. Because what if somebody comes in and says, hey, you're offering 150, I need 200. Do you just pass on them? How do you make that work?
To answer the original question that Graham just said, and I think Mary will have a tie to this, as a founder or the entrepreneur piece of it, the vision, and we're sales leaders as entrepreneurs, selling that vision, storytelling is so key and critical. I mean, if you're either a sales hire out there or a founder, if you're a sales hire, you want to believe, of course, in what you're selling, the product, but you want to believe in the vision. It's not going to be completely fleshed out at that point in time. There's going to be challenges. You might be in a really noisy space and you're trying to differentiate. You might not have marketing. You probably don't have marketing. Who needs marketing when you're in sales anyway? And like all of those things are really, Mary's laughing over there, I think. And that's the truth of the matter is, you have to take on that burden. You have to be a partner to that CEO, to that founder, to the VP of sales, and help them along that journey. And really just build the framework and lead by example. And hopefully they're doing what Graham is saying, is like, hey, we're going to comp you. We'll do, I don't know, some level of draw, or I would just comp full OTE for the first ramp of 6 months to a year, if you could. That's a really important piece of it, because you don't want comp to actually even be in playing field. As soon as you hit scale, and scale is probably 5, depending on the sales cycle, if it's enterprise 5, maybe more transactional 15, you should be standardizing. And Graham will hit this all the time, is like, everyone's going to talk, so they all know what their comp is anyway, but it all has to make sense within the business model. If you have all these different rates and challenges, first off, good luck with your commission tracking spreadsheet, because that's BS. That's where we come in. But that's a challenge by itself. And then 2, if you try to add levels to it or different roles, it's just going to all fall apart, because you can't measure things like CAC or whatever you're looking at, because it's just too confusing. And Mary, I'm sure you have some thoughts on this as well.
Yeah, so let me talk about the part of the question. Yeah, I laugh when you say you don't need marketing. Come on, man. Okay.
I'm joking.
No, bad stereotypes, AJ. Come on.
I was kidding. We have a fantastic marketing team. Graham, you were a marketer at Trunkite, so you get
the marketer at QuotaPath too.
What you don't need is bad marketing. What you don't need is marketing produced by people that haven't talked to the customer or been in the field or really have a clue about the pains and problems you solve and who your buyer is. But yes, you need good marketing. Okay. The difference between startup sales comp and the 91st hire sales comp. The 91st hire sales comp should be highly data driven and built with incentive with a purpose. So 1, base salaries should be very comparable based on the region, based on a pay scale that's relevant in the region. If it's also remote, hybrid, or required to be in person, It should also pertain to the sales cycle and the complexity of the role, and then the market segmentation, like small biz, mid-market, up-market, enterprise, are typically the indicators in what changes the comp. But the 91st sales hire should have a comp plan that's based on a greater comp model that is based on like the sales pro forma. So it's a very data-driven calculation. Additionally, that 91st sales hire, by the time you're there, you should be able to have like sales by geographic region or by buyer type or vertical or segment, whatever it is, so that you actually know what the role in that specific carve out is capable of producing top end, and you're able to back into it. Then you can take what your margin is on the role against what's happening in the market. So if we're seeing salary increases and the role is becoming more competitive, you should be able to look at your margin and say, what more can we take out of the margin in order to increase the OTE here, which is what I believe Graham said in the opening, is we're starting to see the relation between OTE and top line quota or revenue production shrink, which is meaning that we're offering more money to do the same level of production, which would be in line with what we're seeing in the market. But a 91st sales hire, the comp plan should be part of a greater comp model. It's highly data driven. It's tied into KPIs and performance. That's very clear. And then the incentives in the plan should work in the company's favor. So let me break this down. When I was selling for the payroll and HR company, very purposefully, the fiscal year started over on June 1st. And then the first 200 and some thousand in revenue you sold was at an 11% commission. But then when you hit 270, it jumped up to 17%. And then it jumped up again at a next. And so you had these multipliers that would increase. The reason is 25% of the annual business in the payroll industry historically was done in January. And selling season was October, November, and December. With that, if the 25% of your annual business is done in January, you had an opportunity, if you started the year off strong between June through December and it got to your biggest multiplier, your biggest month of the year was paid out potentially at 40% commission. So it was a race for salespeople in a slow season. So June, July, and August is slow just for a lot of people because it's summer months, decision makers are on vacation out of school. So the comp plan made the commission during that month terrible. So the salespeople would be super hungry and sell just to get through the first 270,000 when they were starting to make real money. Then the goal was, can you get to the 40% multiplier by the time you do 25% of your annual business in January? And then what would happen is when budgets and business are good, when the year refreshes, there's naturally good business coming in January, February, March, April, and May. But that's when the reps, they're at the high multiplier. So they make so much money, they take their foot off the gas in January, but that's naturally like when good business is being done. But then they purposefully lower the multiplier when business is slow and making them work harder. Then the last thing is the bonus was delayed. So the annual bonus, there were 2 tiers of bonuses to qualify for, and they would not get paid out until September. Also, the President's Club, also known as conference, that incentive wasn't until September or October. So reps that wanted to leave in June or July would have the carrot dangled of like, I can't get my 25 grand bonus unless I stay through the end of September, and I can't go to Hawaii unless I'm here in October. Well, guess what happens by October? They're in the next realm of the multiplier. They're also building their January business, and they just have constant carrots dangled. So by the 91st sales hire, your comp plan should be dialed into the level that you have retention of your reps and you're incentivizing the right performance at the right time of the year. This was like so amazingly built. But when you're a startup, like you have no data. Like you just need to do what you need to do to have a really good base salary where the person is taken care of, honored, and respected for what they're bringing to the table. Open up some equity, open up some options or whatever that you can put together in a loaded comp plan. Make sure it has lots of exciting things in there that salespeople like autonomy and time on, blah, blah, blah. You can walk their dog in the middle of the day. But that is what would attract that earlier stage, and then just being true to the numbers. So my hope is like that much detail shows the difference.
Yeah.
Between the 91st.
And I think that's awesome. And I loved hearing that example of the different ways that you can build a comp plan that accomplishes the goals that you're looking to accomplish as an organization. I think that's a wonderful example. The issue that I've been seeing recently is you have all of this dialed in, you have this set up, it's incredibly data driven. And then somebody comes in and says, okay, but I want to work for XYZ company, but somebody's offering me 50K more at another company. So how do you convince them to work for you at 50K less when they're being promised 200K at another company?
Oh, I just tell them to go work where, if that's what's more important to them, then just go
You
freaking
just let them go. I mean, that may be the answer.
Full transparency. Full transparency. Go there.
Yeah, I mean, and that may be the answer. AJ, did you have something on that?
Well, I agree with Mary on that. It's like, well, that's not a fit. It's like that's not a fit. I think the part of it, the visibility piece of it and transparency, if they're going somewhere else at that price point, like they're most likely not going to get that level of visibility and transparency. Mary just laid out like this great kind of story throughout all of the months on how we're thinking about it. But it's really challenging. 80% of sellers don't really have that visibility into how their compensation plan is built. And that was the challenge that we were thinking through at the very beginning of this, is like, how do you bring visibility from a rep standpoint to understand not just what their comp plan is, but how that makes them feel. Of course, you can add goals and add things of attainment. Like, I want to take a trip to Bali or whatever. I want to pay off the down payment on my grandfather's house. You should be able to create those goals, but you have to understand the triggers before you get there and be able to forecast those out. And that was the thing that, like, at the very beginning of this, that crux of the problem, we're like, we can do this. That's actually is what we've done, is create a world where that visibility has to be there. It doesn't matter. I think that the conversation we've had has gone from one sales rep all the way up to hundreds, but everywhere in between, there's this opportunity to create more transparency across the organization and how you're performing and what are those triggers. Pretty important as well.
AJ, you can say,
I was just going to say there's a handful of questions then that Mikey.
That's what I was about to kind of loop in here, because I do want to get to kind of best practices of comp plans and what that looks like and how to do that. So we got a question that I want to address from Taylor. He's interested to hear more about best practice in regards to sales hires comp plans, right? So do you find the best performing sales people are more drawn to lower base salary and higher commissions? AJ, what do you think?
No. They tie to higher base. I mean, 50-50 is the normal here in the US. I think I've seen that pretty standardized. If you give a sales rep, any sales rep, doesn't matter, good or bad, and like you incentivize them. I mean, there's a line, I'm sure, but the base to variable, they will always lean towards base. I get it from a stability, predictability standpoint. Mary, would you agree with that, or have you seen something different?
It has shifted. So my base salary used to be $42,000, which I didn't even care, because making $300,000 or so a year is like, what base salary? So that used to be the way of thinking. And I think that it used to be true. That true, like, inside core DNA salespeople just don't really care about the base. They're playing for upside because they're confident and they know that they can achieve it. So they would take the plan with higher upside. However, what I have noticed is over the last decade, specifically the last 3 or 4 years, is that the market has started to offer so many positions with high base salaries that now the salesperson has a choice. So even if they were really fine with like a lower base because they know they're going to perform and they're going to sell a lot, if they have 2 options on the table and they're seemingly similar, like, they're just going to go for the one that has a higher base salary. And because there are so many employers offering that now, it's really hard to compete with a lower base. So one side note here, one of the companies I'm currently scaling and serving as a CRO for, I have a $75,000 base for a full cycle salesperson, upper small business, not quite mid-market, market segmentation size. It's a 1 to 2 call close, and it's a service sale, no product or technology. And there's proven performance that you can make above 275 OTE. So 75 base for 275 upside. I'm actually getting significantly good candidates. Interviews have been fantastic, but it's because I can prove as the CRO, like, I have 2 people hitting this right now, and that's what they care about. So I think why salespeople are going more and leaning more conservative, even good salespeople on those higher bases, is because, as I said in the beginning of this, a lot of comp plans are misrepresented. And it's a lot of hope and like, oh, you can make $300,000 a year here. And it goes back to, can you though? Like, who's making that? Like, how many reps have actually hit that number? And I think a lot of salespeople have been burned. So now it's like, look what a lot of really bad comp plans did over the last decade with all these dangled carrots. And then a bunch of really good salespeople got burned. I don't think it's lack of belief that salespeople can't perform at that level, but without that proven track record that people have done it before, if they're given an option, they're going to take a higher base salary. And that's consistently what I've seen.
Yeah, that burned effect, Mary, is unfortunate because I like that's just become everyone who's how can I outdo the other company to try to attract someone, and then eventually that just all falls over. And I think it's made worse by that there are a lot of sellers that have gotten the fool me once, that's fine, fool me twice. Like they continue to get fooled. So you'll see the job hopping piece of it, chasing bigger OTEs. And as a seller, you have to stop and think of like, what am I actually going at? Like, what do I want to actually achieve in a career? So that 42,000 and making the $300,000, it's probably rare that you would see that in today's world. But there's absolutely opportunities, and I would say like the seed, Series A, Series B startups where the go-to-market is just getting its swing, that the company has nailed its positioning, probably product market fit. Those are like the type of organizations like joining right at that time, at that inflection point, can have massive gains. And of course, there's lots and lots of companies that you can think of, like Outreach is obviously has those. I've had a friend that was a seller there in 2014, 15, or 16, one of those years around there. And I remember hearing about that inflection point. You hear about this from friends. And I think a lot of people are trying to chase that inflection point. So recruiters are saying like, oh, we're about to like launch this or do this. And we just got this investment and this massive capital and we're a unicorn. Yay. But there's a lot of like shallowness, unfortunately, behind some of these still.
Yeah, I just have to, sorry, Graham, let me say one thing really fast and then you can take this over. But the smaller the company, the earlier stage, and the less proven that it is, the salesperson wants to be protected. And they don't want to take on the risk like the founder does. And if you're bringing in really great sales talent, they want to know that you're there to acknowledge we don't have product market fit. We have a competitive space. We have a product roadmap. Like we're a little bit behind on a few things, like, but we're getting there and we're trying. We're still raising. Like the salesperson needs to know that and make it known that they are taking on a lot of risk to go to work for a younger company that isn't proven in the market yet. And a lot of people will look at that as like, oh, the salesperson is super entitled and they want this huge base salary. It's like, no, it's just they're really talented, they're really good, and they could grace any other company with their presence and make that company millions of dollars. But they're going to choose to do it with you. But you are not proven. You may not even have a benefits package at this point. And your tech roadmap is a little scary that some key features the market's going to want you don't even have yet. And you're like promising that it's on the roadmap. Okay, you got to then like give them a little bit more if they're willing to say yes to working with you. And it's weird because some founders are like, I want them to have skin in the game. I'm like, trust me. They do. This is a huge risk for their career to come and work for you. And I think a lot of times, like they feel comforted with more guaranteed income, just a bigger base salary.
And that's interesting. A couple of things you said there. I'm curious about equity as part of those early sales hires. I get asked this question pretty frequently, and it's not something that I've done much research, like much independent research on. But I'm curious, AJ, I know AJ does because I was the second sales hire at his last company, but is equity a portion of offers to those early salespeople?
Well, you already said you already ruined it, so I can't.
Oh, okay, sorry. Okay. Why is that? Why do you offer them that? And are there one thing that I see every once in a while is like in lieu of accelerators. So things you get more equity.
So the thing that's happened across the board in the last 2 years is employees generally at startups, businesses, sales, or otherwise, have gotten a lot smarter about equity. sales hire recently we offered asked how many shares outstanding does the company have, and I thought that was unique. I was like, this is the first time someone in sales has asked me that question. I appreciate that. So walking through that and what that means is pretty important. I think the other thing you have to be careful of, just because a company's, in fact, I would actually flag this, a company raising a lot of money can be absolutely detrimental. I think that employees just don't quite understand how strike prices, especially if you haven't gone through an exit, how a strike price happens and the value of common versus preferred. Those are two different things. And so if you raise at a $500 million valuation and the company's doing $1 million in ARR, which there's lots of companies that are doing that, it means it's going to take them years to grow into that valuation. So if you bought your shares in 2 years, they probably haven't even grown that valuation. You're losing money. You're underwater because of the company's not going to sell for that. Now, there's a whole lot of caveats to this, but it's just something to be really mindful of. And the number of shares is meaningless. I've had an offer letter about 2 years ago saying like, well, my company's offering me 10,000 shares and you have 5,000. Was like, that 5,000, 10,000 of what? 10,000 of a trillion? Like, it doesn't, that's a totally meaningless number by itself. So if you're going to ask the questions around equity, that's great. Fantastic. I would happily have that conversation with you. Just be informed, understand it. So it's an intelligent conversation to have, and it just doesn't feel like it's a fairly shallow piece.
Yeah, I had a lot of employees when I was in startup phase at House of Revenue that wanted stock as part of the early comp plan. I'm like, we're a service company and I have no intention of selling it. Why do you want stock? Do you understand how a service company works, especially with a founder that has no exit plan? What do your dollars turn into? Like, this is worth not very much. So can we just focus on a different part of the comp plan? And I think it's one of those flashy things. Be like, I work for a startup and I have equity. Like, it's a excitement thing to share, like a vanity thing. And it is completely what you said, AJ. What does it actually equate to? Do you understand how it works? And so if we're giving advice on this, is if the company has a very clear plan, like, and this is easier in some like a product technology as an example, because there's usually a 3 to 5 year plan. And if that involves an IPO or acquisition, then the stock means something. And then it can absolutely be used as an incentive. And I would 100% use it as part of your recruiting plan if you're clear to say, this is the stock, this is what it's worth today, this is why this is meaningful, and here's the plan on what this is going to mean for you at this point and then at this point along our journey. And then that's an intelligent conversation where I think it makes sense. But if you don't have that clearly rolled out or identified, you're like, well, let's just see how we grow over the next 7 to 10 years. And then, we may look at this, and that's not defined, then those numbers aren't really meaningful for the employee if you're going to be serious about it being part of the comp plan. So that would just be the discernment there. The other thing I would say is, like, me being a founder and CEO, like salespeople, Mikey opened up with just a ton of turnover stats. And this market is really hard for salespeople right now. So unless it's like a very strategic hire, like someone that's going to be sitting in a VP of sales or CRO seat or someone at a strategic level, I would pull it off the table or use it as something that they could earn, of saying, we could have a stock conversation, but we're going to have that after 1 year of you working here, and we'll open up the conversation. So somebody put in the question about an ESOP. So if you have a pool for employee stock, potentially it's like, hey, after a year, after 6 months or whatever that is of employment, you could become eligible, and then potentially based on their rank role or whatever, it equates to a certain amount of stock that they could have access to. Or if they go for a year, hey, upon the 1 year anniversary, we're reevaluating comp in lieu of X amount of base salary, we're going to actually convert that to equity. So I think there's a lot of options down the road, but for some people, they just don't even understand what stock is. So you've got to get to the definition.
I want.
Oh, go ahead, Mike.
Sorry, no, you go ahead, Graham. Please.
Oh, I was just going to say that I'm a big proponent of providing the equity and stock for salespeople, and especially as part of that conversation that I was talking about earlier, where you may be competing against a company that's offering a shitload more cash, and you still want to hire them. That can be a great lever for you, is to say, like, what kind of equity are they offering, showing them the long-term value of that, showing them the ability to earn more in the long run. But I come from a very like SaaS centric VC funded world, so in the product world. So
I want to follow up on that one there, or what we're going on here before I let everybody go. But would you typically set up, another question that we got here, an equity program where the stock vests slowly over time to encourage people to stay with the company?
Yeah, definitely. I mean, I think that's a great way of doing it. AJ, I saw you on mute as well, but
that's a standard way to do it. A 4-year, 1-year cliff. That's pretty standard. But the one thing that actually is changing, which is unique, and I think is something that candidates should ask for, is exercise. And the length after you leave the company is usually a 90-day. There's a 90-day window where you can exercise. I'm starting to see startups get a little bit like, why? If I have someone that's done the work to reward them, allowing them up to 10 years even to exercise. So what that means is if they left a company, you might not exercise because you don't want to pay that, and you have a tax liability, blah blah blah. You want to wait to see how the company does. Just you can take your stock options and just hold them for a period of time post that 90 days. And I think that that's a little bit more unique and trendier right now.
Well, now I know how to negotiate a nice with you. It's apparently he's open to this. So, no, that's an interesting mechanic. I haven't heard of that, AJ.
Cool. Okay, so I got to say one thing. This has been unbelievably informative for not only, I'm sure, everybody here, but for myself. I've learned an absolute ton from all you guys. And this has been, honestly, one of my favorite conversations with how this worked. It was great. I know there are still a ton of questions. We won't be able to get to them all because we could be here for another hour and a half, 2 hours, speaking about this, as we see that Graham, AJ, and Mary are very passionate about this. But I want to thank you three so much for taking the time to join us here today. If there are any questions that we didn't get to, I know there's quite a few. Please go follow Graham, AJ, or Mary on LinkedIn. Send them a request. Send them a message. I'm sure they'll be more than happy to answer any questions you have. And also, thank you, QuotaPath, so much for sponsoring this webinar. Go check them out. They're doing some incredible things, as you can tell, based off of what we spoke about today. But again, AJ, Mary, and Graham, you guys are awesome. You were rock stars. Thank you so much for blessing us with your knowledge, time, and expertise. And I can't wait to learn more from you guys next time.
Yeah. Thank you, Mikey. We could definitely talk for another hour and a half. We'll just sit here. We'll be in
AJ and I
our phone booth. We have a one-on-one next. I'm pretty sure of it.
AJ and I have we do speak a decent amount as well on webinars and stuff. So if you follow us on LinkedIn, we post about those.
We're definitely inviting Mary to the next one, though, without a doubt.
Mary's gonna host.
She can take my place. Yeah, seriously. Fantastic.
No offense, Mikey, but she.
Hey, man, you know what? Like I felt like I was just part of the audience. It was great.
I mean, you do. That's great.
I've got notes.
Sorry. Go ahead.
I've got notes galore here, so I'm a happy camper.
Yeah, this was great. I will just say you can find me at houseofrevenue.com. Tons of resources there for you to download. I wrote a blog about compensation plans a couple of years ago. And it should be on there somewhere. I don't know. See if you can search on comp, but I did a full outline on my favorite way to construct a comp plan and all the different milestones and incentives. And so if you like anything I had to say, it should be up on our blog. Go check it out. If for some reason you can't find it, just send me a message on LinkedIn and I'll find the URL and send it to you.
Kelly dropped it. You can find me on LinkedIn. I have a show where I fly around the country in my airplane and interview sales leaders in the cockpit of the airplane called Value Props. Yeah, seriously. Episode 5 went out live yesterday. It's right there. So check that out. I have a lot of cool episodes. I said something disparaging against marketing in general earlier. I want to correct that and audit that right now for the record. our our marketing team is badass. So just FYI, we love our marketing team. Thank you everyone.
Amazing, guys. Well, also go over to Sales Hacker. We got tons of stuff on this here as well. So go check it out. And one more thing before I let you all go. Remember, we're going on the road. April 26th, Boston 28th, New York, May 10th, Chicago 11th, London, and 12th, San Fran. So come join us. We'd love to see you guys. Okay. And thank you all again so much. Have the best rest of your week. And we'll see you again soon.